Welcome to the Dividend Talk podcast, episode 68, quarter two portfolio review. Hey guys, welcome back to another
It's
episode.
fucking quarter three.
Oh shit, yeah. Hey guys, welcome back to another episode of Dividend Talk. This week we're going to talk a little bit about our portfolios over the last quarter. We have some news of the week. We'll review some portfolio from our community, and there's lots of questions that we're going to answer. So, European DJI, ti veo dentro. Hola, mi amigo. ¿Cómo estás?
Very good us. How about you?
As you can tell, I'm freshly back from my Spanish holiday. I've learned lots and lots of new words. I had a great time. And man, yeah, I wish I was back sitting in the sun, having a cerveza in my hand and just relaxing. But I did miss recording this podcast. But yourself and Dividend Dane did a super job last week. It was quite popular actually, talking about real estate investment trusts.
Yeah, well, Dividend Dane, right? He's just like Mr. Real Estate for me. He knows his stuff inside out. I'm always impressed about that he even knows the different regulations or the different setups between the US and Europe. Yeah, no, it's good to have such people in a close circle and, to have them share their knowledge with the community here. I really, when he speaks, I'm quiet. That's really what it is about, so.
Yeah, it's the beauty of having a community, and look, it's something we're trying to build on Twitter, on Facebook. It's I mean, we have some great people here, and we have some great conversations. So I am happy to have these guys in my crew.
It's, by the way, good that you mentioned it because our Facebook continues to grow. So if you're listening and you would like to ask questions, not just to us, but also to fellow dividend investors, then please just search on Facebook for Dividend Talk. You'll find it and just sign up or follow us. And there's a group connected to the page. So don't forget only to like the page or to follow the page, but also go into the group. You need to answer 2 questions to keep all the spammers outside. And then, that's where we also ask people to submit their questions for the Friday show as an example. And the engagement is increasing.
Cool. Well, that's enough self-promotion for one episode. Let's get straight into the news of the week.
Yes, I'm so surprised that, your little country on the island there agreed to a global tax rate. Now, tell me, you've been often telling me on the show here that this is almost impossible. Something changed. What was it? Explain it to us.
Okay, so if you read what the papers tell you or the media tell you, we gladly skipped into this when Europe have said that they removed the word "at least" from their proposal. Okay, but what actually really happened is Germany and France held us up by the scruff of the neck and basically told us we will be screwed economically if we don't agree to this. So we being the good boys of Europe, we had no real choice. What kind of surprised me was our Taoiseach, Leo Varadkar, has said that with the increase in tax rate, our state revenue will decrease by about 2 billion euro. How is it possible that your tax rate or your income decreases as the tax rate goes up? That just does not make sense to me. But I suppose, look, one important thing to know that this is not across the board. This is not for all companies. It's only for companies with a turnover of greater than 750 million.
Yeah, and I guess those are typically the companies that are using Ireland also for tax avoidance, right?
Yeah, but I'm sure that they'll probably set up 2 companies earning 749 million or billion or million euro each, and
Yeah.
look. There'll always be loopholes. Look, to be honest with you, I'm quite surprised that we agreed to it so soon. I know we were a little bit bullied into it, but it is actually a good thing. To be fair, having a standardized global tax rate is a good thing. And
Yeah.
we always talk about standardization in Europe with tax and all this. So maybe this is the first step into something like that.
Yeah, what I also like about it is that the big companies also will be taxed at where they generate their income, their
Yeah,
revenues.
yeah,
And this is really important, I think, that Amazon and Apple start to pay taxes in the countries where they also sell, because countries need it, yeah, here, because first of all, small businesses are outcompeted because they
yeah,
might not have the skill to compete with an Amazon or the likes. They're just entry barriers and switching cost. And secondly, they do make use of the infrastructure, all the Amazon trucks and everything. So I think this is a really fair proposal to tax where you generate your income, specifically for digital businesses with a physical presence.
yeah. And look, I mean, there's no change for small companies in Ireland. I know I used to have a company. It would have been no difference to me. It's still a lower tax rate. So
Mm.
they are taxing companies that can afford and should be paying this tax. So more power to them. But I mean, if you read the small print, it does say a minimum of 15%. I can see that getting increased over time.
Yeah.
You can see that
Well,
getting
I can
increased.
tell you in Poland, they're overhauling the whole tax system. So it will be fun. They have some special issues here, I think, with the government. Also, I think with the court system here. But a lot will happen, and I don't know actually how it will personally impact me. I think I will need to pay more income tax. I just hope that they stay away from the dividend tax. I know that they're not taking the personal dividend tax, let's say, that they're doing something with, but intercompany money transfers and dividends, I think that's what they will be
Oh,
more focused on, and it's from a protectionism point of view. So there's
interesting. Yeah.
it is still busy everywhere in Europe with this. Hey, but another one, I mean, we have to talk about at least one of these, and you may choose either the Facebook hearings or the oil and gas prices. Which is closest to your heart?
Oh, I mean, they both are, aren't they? Really? Like, let's talk Facebook first.
Yeah.
I mean, it's all over the news, and you have got this whistleblower coming out, and I'm not really surprised at you. Let's be honest.
Yeah, so I watched the whole hearings of the whole hearing of the whistleblower. It was live on CNBC on YouTube, and actually there was nothing surprising for me. Right? You need to look at it like this. I think Facebook probably doesn't feel like they need to be the police officer of what's good and right in the world. Yeah, I
Yeah,
think they struggle with that responsibility, and I think specifically U.S. politicians want them to take such a responsibility. But then I see US politicians that are also really hands off because they are not implementing proper regulation to regulate social media either. Yeah, so it's just a mess, and it feels like therefore Facebook is the bad guy because they are understaffing a lot. But what is just Facebook? You get, and it's on many social media platforms. You just get all the shit and the dirt out there online
yeah,
because people can hide them behind their identity. So this was happening. Of course, Facebook with Cambridge Analytica was doing dirty stuff there, allowing this to happen. Yeah, so it just shows me. But the whistleblower was really clear in this, and what I really found interesting that she said, like, Facebook did their own research and specifically about Instagram,
yeah,
as an example where children do get self-esteem issues, which I can relate to what she mentioned, because she mentioned, like, okay, Twitter is about news, Facebook is about connecting with family and friends, but Instagram is really about beauty, yeah, and lifestyle, and
yeah,
this is where people want to show better off than they are, so it also creates kind of an expectation and therefore mental health issues. But what really caught my attention, that someone asked something, and then the lady mentioned, like, we knew that states like Iran, China are using Facebook for monitoring their citizens and use it against them, and the espionage team that she was leading was understaffed, so they couldn't discuss that topic there. But I think there will come another hearing specifically about that, because I think this is what Republicans and Democrats will be really like hawks on to really get to the bottom of that. So that was the main line that I got a bit worried about. Like, okay, hey, if this is if they really pick on this, then I think that they can can come really tight regulation there.
Yeah. Yeah. And look, you're talking about Instagram. I put YouTube up there with Instagram as causing mental health issues. They're not great for children, but it's our job maybe as parents to try and protect our children a little bit from that. So there has to be some responsibility on our
Yeah.
side. You're right. Facebook are not there to police the world, but it is scary that these platforms can be used to do more harm than good.
Yeah. Yeah. So that about Facebook, by the way, I'm keeping my shares because I know that when politicians are handcuffed with what they are doing, or this paralysis, then the earnings will keep on growing. We just need to keep an eye on the iPhone App Store impact here. But then oil and gas prices, because wow, have you seen the natural gas prices? It's shot through the roof. It's like tulip mania there.
It is crazy. I haven't really seen the prices. I did check Brent crude oil, which settled above 80, I think, for the first time in a long time.
Yeah,
And it is really skyrocketing. And I spoke to you before the show, and I didn't realize that Royal Dutch Shell was at 20 euro.
€20
So
now. Yeah,
yeah, so there's huge gains over the last little while on oil and energy, and we've been saying it, haven't we, on this show? And we've got a lot of people fearful energy is dead, oil is dead, it's not going to come back. There was no planes in the sky, there was no cars on the road, and we said these will come back, and oil will come back, and you can be
yeah.
sure it is coming back. And
And
but
in many countries, there are more traffic jams than before the pandemic because people are avoiding public transport because of the mask wearing and still the fear of viruses. So many people are taking the car now. But generally, what also caught my surprise is like that in North Europe, there's not enough wind at the moment. So and here we really need to give credit where credit is due. And this is Ben van der Burde, the Shell CEO. When he took over from Peter Voser, like several years ago, he said, "We're in 2016." He said, "We're going to buy British gas." And why? I think they paid up 60 billion or something like that early in the oil crisis. He said, "We do this because we believe that LNG is a transitionary energy to help us to a more climate neutral world. We need gas." What do all the electrical power plants at the moment? They need input. Brown coal is the best performing commodity at the moment, together with natural gas. People don't want brown coal, so we need natural gas, but there's a supply gap here. I think it's brilliant from Ben van der Burde. He was spot on with his prediction that natural gas will be the transitionary energy here,
yeah,
and I really need to give him the credits here. Of course, he had to cut the dividend at the time. He's doing as well now, but I expect major earnings for Shell,
yeah,
and I expect a lot of buybacks. I don't think they will keep on increasing again the dividend right now already, but I think we will see massive buybacks
yeah,
coming here.
yeah. And actually, an interesting stat is that the demand for natural gas has now exceeded pre-COVID-19 highs. So,
Yeah,
I mean, what more can you say? He's proven right.
yeah, exactly.
Cool. So we might move on then to our portfolio review. If you want to go ahead maybe and talk a little bit about how you performed over the last quarter.
Yeah, definitely. Let's start with the third quarter acquisitions because I was a bit on a buying spree, and I'm noticing that I bought none, not even one US stock. So I bought Philips, I bought Royal Dutch Shell for around 16 euros still in July. So Philips in July. I bought another set of Unilever in July. I bought some BASF. I bought some Allianz twice. I bought Rio Tinto a few weeks ago. And I bought a lot of Alibaba because for Alibaba is for me a part of my 10% growth portfolio. It's a stock that I hope to earn 26 per year annualized on over the next 3 years. That's my goal.
Yep.
And I reinvested dividends in Koninklijke Ahold Delhaize, Royal Dutch Shell, and Unilever. So I was surprised when I saw this because I wanted to focus a little bit more on US companies, but I guess what they all have in common is they have a decent yield.
Yeah.
So, with that having said, also my projected annual dividend income has also grown nicely. I said it's now at a nice level around, let's say 33, 34% from where I needed to be here pre-tax.
Yeah.
I did also sell one share, and that's or one company, that's SAP. I bought SAP, like, I mean, like a really small position when I wrote an article about it earlier this year, I believe, or late last year. It was around 90 euro. It went to 120 or 125. And I thought, like, I don't actually need it in my portfolio. So I cleaned it up with my cleanup. So yeah, those are the acquisitions and the disposals. And then my net dividend income, which is really interesting. In July, I earned 5% less dividend income. That was because during the pandemic, July was having a lot of dividends of companies that postponed their dividend earlier on in the year because of the outbreak of the pandemic. In August, I had 49% less dividend. And that's because, for instance, a Koninklijke Ahold has shifted their dividend into the first week of September. But in September itself, I grew 120% of dividends. So overall, over the third quarter, compared to last year, I received 25% more dividends year over year, which for me is a really, really, really great number, because we're talking here about kind of the compounding impact
Yeah.
of dividend investing. My portfolio yield grew from 3.13% to 3.32% with these acquisitions. My portfolio grew quarter over quarter around 10%. Most of this is by acquisitions,
Yeah.
not so much by organic growth. My largest sector is still consumer staples, but it declined with a percent point because of energy. I'm still heavy in energy with 20% approximately. So these oil prices will do me really well. I'm so much looking forward for earnings seasons. My largest holding is Microsoft with 8.4%. It's already for some time, but there's a new kid on the block, and that's Royal Dutch Shell. It took over Omega Healthcare as my largest dividend payer, and this is because of the addition of another 100 shares, and also because of the massive dividend hike that they did
Yeah.
around Q3. It might be that Royal Dutch Shell, if it keeps on growing in share price, that it might overtake Microsoft as my largest holding in fourth quarter. And then, yeah, this is my portfolio performance. I'm really happy with it. I really need to focus again a bit to bring back some US companies. I'm studying Bristol Myers a bit now, looking into their pipeline, because this is a company where I don't really have a strong feeling about. I initiated a position in quarter two, but now it's under my fair value. So I really want to study a bit more. And with pharma companies, you really need to understand the pipeline. And
Yeah.
they acquired Celgene, so I hope that this will be a company that gives me promise, so that I can get back to some US companies again.
What is your current split then between US and European companies?
Okay, I would need to quickly look that up, because I'm actually not tracking it, I think. So I have no clue. I think it's probably 50, 60% or something like that.
In favor of European, I would say at this stage.
It might be still slightly American.
Okay.
Yeah.
But hey, no, there's some nice companies there that you bought. Obviously, Baba is the big one. That's the one that everybody was talking about. But I think you've either wrote a post or have a video on most of those companies and why you bought them.
Yeah, true. On most of them, I have posts or videos.
Yeah.
Indeed. Yeah.
And why did you sell SAP?
It was a really small position, like 600 euro or 700 euro. It grew 20% or 25% in a year. And I thought, like, actually, it's small. I don't even need SAP in my portfolio. That's just what I thought. So I rather allocate this to another kind of company, this position. Not convinced about SAP. It's generally a good company with a strong lock-in. I don't see it disappearing anytime soon. It's just like that. I have no love for it. So simple like that.
Fair enough. Cool. No, that's quite impressive. It's nice to see how much compound interest is, how much compounding actually works when you see that you're reinvesting into shelling. I think you said you get like 7 shares now out of your dividends,
Yeah.
which is quite
Yeah,
impressive.
it's really a substantial position now, and I feel really comfortable with Royal Dutch Shell. It's not going anywhere in the next 10 years, so I'm really happy with it.
Yes.
How about your performance in Q3?
So I didn't buy as much as you, and I don't think I'd have. So I bought Royal Dutch Shell. I did that. I think I spoke about it on one of the shows here just after their last earnings, and I wanted to just round them up to 200 shares. So I think it was 20 shares or something. So I bought them. I bought Orange Telecommunications Company, which I've spoke about before. So I initiated a small, well, it's medium-sized kind of position in them. I really think that they can grow. It's not a long term. It's maybe a 3, 4, 5 year plan. And if they get to a certain level, I will sell them. I bought some more Clonay Kilke Al Hod Del Haze. That was a put that I bought, so it was another 100 shares added. So I've been buying and selling puts and calls on them repeatedly over the last couple of months. Blackstone, I put a starter position in them, which I spoke about on the show. I gave them as a stock pick actually. So please know that when we give stock picks, it's usually companies that we are interested in. I bought some Alibaba because of FOMO. Um, no, I bought them. I know in our community we're talking about them, and I think it's a no brainer. I bought about 20 shares. I think it's around $160 that I got them at, so I'm quite happy. Texas Instruments, I'm buying one or two of them every month, so I just keep adding to them. I love them. As I said, they're like Microsoft to me. They always seem too expensive, so I'm dripping in and out of them. So it's not a large position, but there's two others. There's Rio Tinto, which was inspired by you. It's really a small position for me to look at them. So I've watched your videos, I've read the articles, and I have no material. I had no materials in my portfolio prior to that, so I said, hey, I might as well add them. I had a small position so I can keep track. And then Lockheed Martin, which again I spoke about on the show. So in total, I've added 5 new positions this month. So the total number, or 4 new positions, but the total number of companies have jumped from 21 to 25. Obviously, Alibaba, I will sell once they hit my price point, which was 200, just over $200 maybe. My average dividend over month was €146, which is good, but it is a lot less than what it was the previous quarter. Because obviously with the European companies, I earned a lot more. So that was 263 last quarter, 146, but it's still much higher than it was this time last year. Or this,
Yeah.
yeah,
And you're talking about the average per quarter, right?
average,
146.
average, average, yeah.
Yeah.
So more or less, it balances out, but that's average per quarter. My portfolio yield has dropped. So it was up over 4%. It is now 3.94%. My largest holding is still Unilever. So Unilever has been my top holding for the last 2 quarters. Before that, it was Royal Dutch Shell. My largest sector is consumer staples, as we know, which is way too high. And my largest gross dividend is still Altria, which is 17% of my overall dividend. So I'm quite happy. Quarter on quarter growth was 8%. Again, like you, a lot of that is additions into the portfolio, but I didn't actually put as much into this as I did in the previous month. So no, quite happy with my performance on that. What is actually interesting is I do track my option income now, which I shared last time, and it is far exceeding what I'm earning in dividend growth, which is quite interesting. Now I know that the figures here is $1,500, but there's one thing to note with that is that I've been assigned a couple of these companies, so I own a couple of these companies now, and they're trading at a loss. So if I was to sell them, that would come down, but it's still outperforming my dividend income with a fraction of the money invested.
Nice.
Mm.
Nice. And this helps you again to reinvest for dividend stocks, right?
Yeah, and actually, what I've started doing is that I've started researching a little bit into closed-end funds. So we obviously are investing for income. These are high income funds. You get a much larger dividend, but it comes with a much higher risk. So
Mm.
I'm quite a novice at it. I'm just researching and going through companies and trying to figure out my way around that, and maybe have that as a small percentage of my portfolio.
Nice, nice, nice. Well, I think I mean you're a few years behind me, right, in the on the dividend journey, and I mean it's just awesome how you're doing. I
Yeah,
mean, but because we are now for the second year on the podcast, I literally saw you breaking the 100 euro per month. You are now on 146 euro per month. It's really amazing, and it's really compounding at work, and yeah, it's just really nice to see because this 146 euro per month will be really quickly 300 and then
yeah,
400 and then and then it becomes easier and easier to add another 100 euro, right?
yeah. I mean, this time last year, my projected annual dividend income was about 3% of my overall goal,
Mhm.
and now it's seven. It's nearly 8%, seven point
Yeah,
seven
look at
one.
that.
So it grows surprisingly quick. And as you said, with compounding, that's where the snowball effect comes in. So that's what I'm waiting for. I'm waiting for those snowballs to come along.
I think it's important to keep reiterating this because in the first few years of dividend investing, you often get distracted thinking like, "Ah, what am I doing it for?" You see other people that report on like, oh, I made 100% on this stock or something like that, and you get this feeling like, why am I investing for dividends, right? If others are making a quick buck, first of all, others don't tell the whole story, and secondly, it's really the patience and actually the do nothing that really earns you the money. Yeah, so not sell, just stick to it, and you're also a great example of that. And I feel it with my portfolio as well. I said the other day, a 5% hike for me in dividends on average overall equates to me as how is it 7 months of salary contribution, 7 months of investing, just a 5% average dividend hike for my whole portfolio over a single year.
Yeah.
It's mind blowing if you think about this already. And I'm now 6 years on the journey or something like that. 7 months of free money with a 5% hike.
It's crazy, and that's one thing I actually don't track is dividend growth, and when I discuss my strategy, I always focus on this growth, dividend growth. Okay, and I think that's really important. And I look at some of the companies like Realty Income, for example. I have them coming in every month. I haven't added shares to them because I wasn't able to previously with the Hero. That's now resolved, thankfully. But I look at this time last year, and now and I haven't added any shares, and it's added 20% extra. It's absolutely crazy. So it's mind blowing to see that, and it's something I should track a little bit more. Is what how much I get from growth and how much I get from adding. But
Yeah.
it's um it's good to see when you're investing in companies that it just increases gradually without you having to add anything extra into the pot.
Yeah. I'm already looking forward for writing my annual report in January, where I actually include that how much is organic growth and how much is from cash addition.
Yeah, yeah, I know. I look forward to your annual report. I don't track it. It seems a little bit complex to do in Excel, so I'll leave that to you.
Super. Hey, talking about portfolios, let's go to our portfolio review of the week.
Oh,
And this time we have one from Chris Carter. And he is asking if we could review his top five portfolio. His number one position is Philip Morris.
yeah,
His second position is Apple. The third one is Visa. The fourth one is Waste Management. And the fifth one is Target. And together they make up 26% of his portfolio. His goal is to, like most of us have, is to have financial independence and to live off dividends actually as soon as possible. Now, EMF, what are your first thoughts?
I mean, I like the look of pretty much most of those companies. I, I mean, I wish I asked them one question, which is when did he buy the majority of these shares? Because if you look at, with the exception of Philip Morris, if you were to look at Apple, Waste Management, Target, it's almost like a straight up curve since 2017. It just goes straight up. And if he bought them pre 2017, he's made a shit ton of money, and he can reinvest his dividends, and maybe even and sell some of these and make money off the capital appreciation and put them in. But Apple, Visa, Target, I think are three really, really good companies. Waste Management surprises me. I mean, how much growth can they have? I don't know a whole lot about the company. I just know that they are an American waste company. But where do they go in 10 years? I don't know. I don't know enough about the company, but it blows my mind that somebody going around collecting bins, which is what I imagine, can be worth that much money. But I mean, looking at their stock price chart, it just it's after taking off like
Yeah, think about. I mean, when you see the stock chart, you think that the bin collectors are getting a car from the boss or something like that. They must make a shitload of money if I see this company, or not, and the company is just asking a shitload of money from the citizens living there, where they are picking up the trashes.
yeah,
I mean, I wouldn't be surprised if we see Italian circumstances anytime soon, where just the trashes are piling up in the streets because I mean they must earn it from somewhere. But I really like his portfolio. He has a nice core with Philip Morris. Philip Morris is nowadays is an inhalation tech company, not anymore a smoking company. So we need to also remember that. But then Apple, Visa, and also Target with their whole remodeling of the shops. I think it's a really strong top five. I think you shouldn't be surprised if in the upcoming, let's say, years, the returns might be not so much from here. However, the dividend growth might be really stellar still from here, right? And we invest for dividend
yeah,
growth because I think most of these companies, to your point, are overvalued. But I think as dividend investors, we don't really care because this is just portfolio value. It's not the most important. We look at dividend income. And I think Apple, Visa, Waste Management, and Target, they have so much room to grow their dividends
yeah,
that this is, for me, a sleep well at night portfolio. It's also nicely diversified. There's some tech, consumer staple, finance, tobacco. So it is a really nice diversification in the top five as well. And just 26%. It shows that he, in generally, has a really nice diversified portfolio.
yeah, yeah. And do you know what? It's really nicely laid out in between high dividend growth and
Hmm.
high dividend yield. I mean, we've talked about this, and the kind of capitalist has pulled me up on it when I say I'm more into dividend growth and I have higher yield companies where this seems to have a nice balance of both, which
Yeah.
is quite rare to see and really nice. So no, that's Chris. It's a nice portfolio and well done.
Yeah. So, Chris, stay the course. I think you do really well. And if you want to live off dividends as soon as possible, it might be actually sooner than you would think if Apple and Visa keep knocking out of the park. Well done.
Okay, so we'll move on to some listener questions. We have quite a few, so we will answer as many as we can. And we will start with Phil. Yeah, we'll go with Phil again as number one. So, what do you think will disappear sooner, oil or tobacco?
Or the human race.
that
Yeah.
was that was from
That
Dividend
was
Wave. Yeah,
added by Dividend Wave. Yeah. I think the human race will quicker disappear because, now honestly, I think that if anything disappears quicker, it's oil than tobacco, simply for the fact that tobacco plants will always grow and oil will maybe one time, empty. Although oil is also a product of nature, so that's why I think the human race in generally will be sooner gone, because we could be all wiped out, but oil will still be in the ground or being produced by nature, and tobacco, plants keep growing. So, but I think that was not the thinking behind the question here.
yeah. I agree with Dividend Wave. Yeah, the human race. We're gone first. Oil and tobacco are here to stay, baby.
Yes, exactly. Rafa, he asked if there's any company that caught your attention during your visit in Spain.
Okay, there was actually one quite surprisingly, and that was Burger King. Everywhere I seemed to go, so I went to Torremolinos. There was a Burger King pretty much everywhere. We went down into the city of Malaga. We passed like four of them along the way. You come out of a hotel and there's two within walking distance. It just seemed to be everywhere. And it actually made me think over there. Okay, McDonald's. I know they're a great company. Everybody's invested in them. I have never heard a whole lot about Burger King. So I had a look at them. They used to be on the stock exchange, New York Stock Exchange, back in 2003, maybe till 2010. They were owned by Diageo at one point. I did not know that. And now they're part of this Restaurants Brands International, which is quite an interesting stocker. Stock. It has over 20,000 restaurants under the umbrella. Most of them, I think 16,000 are Burger King, but they are other important ones as well. So it is quite an interesting one that I will look at. They have a high dividend yield of 3.41%. PE ratio is a bit high, 28.43, but it looks like a good alternative. I think the difference between McDonald's and Burger King, I mean, they're quite similar in popularity, is McDonald's are clearly a better managed company.
Yes, and I think more attractive for kids with the whole Ronald McDonald and Happy Meal and everything. I see that my kids have way more appeal to the McDonald's brand than to the Burger King. I prefer Burger King nowadays because they have vegan meat,
Yeah.
and McDonald's still doesn't have it. So Burger King, I think, is more innovative. McDonald's is just such a strong appeal to children. It's really, really hard to beat that brand compared to Burger King.
Hey, we have one over in Ireland. There may be some in the UK, and they will be expanding into Europe at some point. But it's called Supermax, and they blow McDonald's out of the water in terms of food
Yeah.
and taste. The kids over here love it. My kids would pick Supermax over McDonald's
Mhm.
all day long. So hopefully they
Okay.
go into Europe, and they'll definitely be a company I'd look at in that regard.
Super. The next one is from Miwa. She's asking, have we ever considered becoming financial advisors given our passion and competences developed?
No, I mean, I have a very niched sector. I looked at dividend income. I feel like to be a financial advisor, you have to look at the whole picture. I know what I want. I know what goals I have, but I would not feel comfortable giving other people actual financial advice that they're going to follow all the time, because you have to take everything into consideration. Don't you? You have to take pensions, the lifestyle. You have to take everything. I can sit here talk about dividends all day, but I'm not going to tell you about pensions or real estate or any of that other
Yeah.
good stuff.
Same here. I wouldn't feel comfortable actually being financial advisor, investing or advising people how to invest their money and build up their wealth. I think it's a really difficult job. And then also you need to, I think the incentives are neither aligned because you will also want money for it. So I think it's really hard to not have the wrong incentives here. However, I would love maybe to be a stock analyst or something like that. So not an advisor, just analyzing companies, reflecting my thoughts on it, and let others judge whether they want to have it or not.
Yeah,
That I could do, I think. So Miwash, if you know someone, let me know. Who knows? I would be more than interested to have a conversation one time.
cool. So we have Chris next, and he's been buying a basket of pharma companies because they seem cheap, which they do. They have rising dividends, but he doesn't have expertise to know which pipeline is the best. So, which seemed like a good idea, and he has Pfizer, Merck Sharp, Bristol Myers, AbbVie, Amgen, and Gilead.
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 Yeah, I think it's a good idea. Effectively, he has made compiled his own ETF with companies with a certain yield. You can clearly see that in here. It's true. You need to really understand the pipeline of pharma companies. So if you don't know it, you can better make a basket. I think you just spread the risk. You also spread your upward potential with that. It's minimized. I think it's just really clever. If you want to own such six companies and are able to monitor them, I think that's good because for understanding the pipeline, you need to understand the molecules behind it. You need to understand the epidemiology. So how many people have this disease and how many people can have access to the disease. You need to understand the how you say it, the competition also for the drugs that they are producing. Is it increasing the quality of life of people? So many dynamics that really requires you to have pharma knowledge. So I think
Yeah.
it's a smart one. that he's
Yeah,
saying. It's really hard sector to invest in, pharma.
very hard. And look, we probably won't do a stock pick this week because we have so many questions. But there's one company that came on my radar recently, which is Viatris, ticker VTRS. So they are a merger between Mylan and one of Pfizer's old business users, Upjohn. Okay, and I suppose they make a lot of generic brands. So I know you have companies there that make the proper brands, but I mean we do have biosimilars, and we know Humira AbbVie's is going to be out of patent soon, and actually Viatris have a generic drug ready for this to go. So if you want to diversifying, you're looking at potentially a really undervalued company it's only formed since November 2020. I think it's one to look into as well. In terms of pipelines, I mean, they have a lot of stuff, as I said. A lot of these companies that you've listed out, they have generic drugs for them, either on the way or out already. So check them out.
Good. Jago's asking, at what age did you begin investing? Why then and not before or after?
Good question. So when you say investing, it's quite a strange word because I remember back before the crash, I had put money into lots of different things. So I told you I put money into FX and lost a load of money. I put money into crypto, made some money, lost some money, but that's not really investing. It was gambling, so to speak. So I started my journey about 4 years ago. Before then, I just wanted to get rich quick and was chasing every fad I could. Went broke a couple of times, and that's why I found dividend investing.
Super. Next question then from Arthur. What about your view on AT&T and the deal with Discovery? How do you view the potential here?
Yeah, we spoke about this. I think we have a podcast dedicated to this. I'm a little bit more happier about this than European DJI is. I'm holding the company. Their share price is going to go, but I mean they're going back to their core. The dividend is going to be cut, yes, but I think it'll still be sufficient, and hopefully there'll be a little bit more growth in the company. And who knows with this new company how they'll do. So I'm holding out and hoping for the best.
So I do just full disclosure. I sold it at 33 after the spike in share price on the news when people didn't know yet what it really meant. Now it's trading at 27 euros. So of course I feel good about that. Um, I think John Stinky, the CEO, deserves to be fired. He bought Time Warner, was heavy with his arm full up in the ass of the management there. Um, he should be out. I don't trust this deal at all. He's spinning it as a positive thing, but come on, it's just a waste of money that he has done. So I don't have trust in management. So I'm biased there. I think they will have a hard time competing with Netflix and Disney. In the end, what we're talking about here is still not top class TV for the mass. So, I mean, how much do you want to watch Discovery and History Channel? Just think about it. And of course, they have the Time Warner, but these are not, for me, A grade content libraries like Disney, which is really like for billions of people. I don't think that this library will be similar. Although I might be totally wrong, of course, because and by the way, HBO is just bloody expensive. HBO Go. So we need to take that into consideration as well. So it will be really hard for them to compete for the share of wallet. That's how I look at it.
Cool. John Stinky gets me every time. Well, we'll move on. So we have one from Razor Value. And how do you feel about using real estate that's cash flow positive to turbo your passive income stream?
So I would love to have real estate, but you need to know one thing here in Poland. You hardly make money on it. If you go for real estate, you bet not on the income, but on capital appreciation. It's much more easier to buy for me a real estate investment trust. The market is so expensive here, so you probably don't even make a profit on the rental income, just because of the cost of it. You cannot lock in your mortgage rate either in Poland. There are few banks that allow you to do for 5 years, but you pay a really high interest rate. So it's really not a good market now for investing for me in real estate, but in a crash I would definitely consider it because it's a way of diversifying for me.
Yeah, cool.
Great.
I'm quite similar. I'd love to get involved, but in Ireland I can't at the moment. So we have a question from someone from the Netherlands who prefer not to use his name, and he's looking to maximize his dividend income and is wondering, is it a good idea to sell stocks with capital gains and reinvest them into another stock? And he's not just saying reinvest them into any old stock. The next stock that he's reinvesting to has to have a 3% yield, has to have maybe good growth potential, similar to what he sold, but maybe it's a little bit more undervalued. And also, full disclosure, there's no capital gains tax in the Netherlands.
Yeah. So what he is effectively saying is a combination of value investing and dividend investing. I buy a stock for 1,000 at 4% yield. It goes to 2,000, so it is 2% yield. I sell the 2,000, reinvest it for a stock for 3% yield. So overall, I get more dividend income and I grow my dividend income like that, right? I wouldn't necessarily do it. I totally understand the thinking when you don't have capital gains. Um, but if you buy a stock for dividend income, I think you need to let it run. For instance, I've bad experience with selling stocks that were just doing well. It's like don't cut your winners, but cut your losers. That's my learning. I bought McDonald's at 90, I sold it at 120, and now it's about 200. I would have had a 7 or 8% yield on cost probably with McDonald's.
Yeah, I think in theory this is a good strategy, and it does seem like a good way to maximize your dividend income. Like you, I've had some experiences with that as well that have not been too good, but I've had some that have worked out. I always say that I tend to be a buy and hold investor, but I think we've learned over the what is it 68 episodes now that is just not the case. There is times when I sell, so it depends. It depends for me if the stock that you're thinking about selling, do you still think there's growth in that company? If so, you don't need to sell. If you think it's run its course and has your thesis has completely changed, then by all means go for it. No capital gains in the Netherlands. I am jealous.
They have wealth tax, so don't worry. It's still significant. Next question is from Davide Doni Facente, and he's asking about your opinion of Vodafone.
Yeah, Vodafone, I think we spoke about them on the show before. I remember they cut their dividend before, and I've never quite got over that. So they've always stayed off my radar for that reason. Um, as I mentioned, I have AT&T. I have a small position in Verizon, but I prefer Orange at the moment. And Orange is where I'm focusing on. Orange are paying special dividends. They're increasing. I think they're doing some good things. A little bit more undervalued for me. I know there's lots, particularly UK listeners here that do like Vodafone, and they seem to have changed. The management seems to change and going in a good direction. But for me personally, I stay away from.
Good. Then we have also a question from Geert Jukna, and we need to show some love for him because he says, I love the podcast and have been listening since the first episode. 68 episodes times, what is it, around 50 minutes on average?
Yeah,
That's,
six.
I said, 3 days like nonstop podcast being listening. So respect, Geert. And I mean, I'm really impressed. I'm really impressed. I could only dream of this, like that someone would listen to us for so many episodes. So thank you for that. He's asking, what are our opinions about building a portfolio with priority one being income as often as possible? Let's say 100 dividend paying stocks. So I treat this like you hear like every 2, 3 days, like ka-ching, ka-ching, ka-ching on your mobile app.
Yeah,
And priority two is geographic diversification. So not only the US and the Europe, but also Australia, New Zealand, Russia, and Japan as well.
yeah. I mean, if you look at, I think is a dividend hummingbird on Twitter, who just keeps adding company after company after company, and he just seems to be getting paid every day. I don't think it's a bad way of doing things. It's not how I do it, but it certainly can work and does work. In terms of geographic diversification, I mean, yes, why not? Why not look at Australia, New Zealand? I actually have chatted about this with, I think it's Value Down Under as well, who's from Australia. There's lots of good companies down there that wouldn't be aware of. Same in New Zealand, and I'm sure Russia and Japan have some as well. So there's nothing wrong with that. It might be safer if you're not familiar with the areas to look at ETFs that covers these markets. But I mean, I think I don't see any harm in diversification, and I don't see any harm in building a portfolio that pays you as often as possible.
What I like about it is that if you now buy a dividend ETF, you get like 1.5% yield for the high quality ETFs. What is nice is you're building your own ETF effectively, but you always can have your lower bandwidth of dividend yield, let's say 3%.
Yeah,
And that's really nice because if you buy an ETF every month, you don't get all the companies at 3% yield. So this is really nice about it. And if you buy the regular companies, I mean, even if you get some dividend cuts, you will hardly notice it if you have 100 companies. So I think it's quite clever. And Alan from Sweden in the Dividend Day chat, he has something similar. And I think it's a nice wealth generating approach.
yeah. And we have another question from, I think it's Manny, and again, it's on diversification. This time it's quite a long question, but this time it's not just diversification within equities, it's diversification outside of equities, bonds, commodities, ETCs, etc. And he asking us what is our thoughts on this.
Yeah, it's not my circle of competence. That's my issue. So bonds, I don't have because I have money on my savings account instead of a bond, to be honest, because I would do it for security and with the interest rates, I'm just not. I I know energy companies, but I wouldn't be able to trade in commodities. ETFs, I'm thinking sometimes of it to put the core pillar of my portfolio still in ETF for something, but I don't see any attractive dividend ETFs that I would like to own right now. So maybe on a downturn, which means probably never. Um, yeah, so it's just not my circle of competence. I can only spend my time once, and I'm building my knowledge around dividend stocks. And that's more the reason than anything else. It's not like I don't want to diversify. It's just my circle of competence.
Yeah, I mean, when you start reading books and you start looking at all the big investors, they talk about diversification, and there was a time when I was looking when I was starting out, and it was put 10% in bonds and 15% in commodities and all this. But I think it's really, really important to understand what your investment goals are, and that will dictate what type of diversification you need. If you're looking to protect your money, then diversification across something like this is probably more important to someone like me that's looking to generate income out of my money. So there's lots of different ways, and it purely depends on your goal. I am a huge advocate of diversification, and maybe not so much in this way, but as we said before, I am looking to get into real estate at some point when it's feasible. I had a business before COVID got rid of that, but I will certainly set up a business again when the time is right. I have dividend investing. I have my job. I do work freelance writing, so I do lots of different things with that generate income. So diversification is key, but what you diversify in, I think your goal and your risk tolerance. And I preach this all the time, but I think those two metrics alone will dictate what you should diversify across.
Wow, EMF. I was listening when you're speaking. Really, really well said. I think there's no better way than to quit the episodes with those words of wisdom, my friend.
Rare words of wisdom.
No, no, no. Come on. I wouldn't be able to listen to you for 68 shows if you were talking crap only. I mean, it's nice for 1 or 2 shows, but for 68 shows, come on. Then I'd rather sit with my wife doing other stuff.
Hey, it was great to be back. I missed this. I missed this last week. It's really great to be back.
Yeah.
Okay, we'll round this up. Thanks again, anyone. I don't know how long this has been. It's probably over an hour, but thanks a million for all the questions. We appreciate every single one of them. We tried to answer as many as we could. And if you stuck around this long, thank you very much, and we will see you all next week.